What's going on, you guys, and welcome back to the Aray Show. So today's a very special day. It's been 6 months since I opened up my M1 Finance account and decided to go on this journey of dividend growth investing. And since the inception of this journey, we've definitely been through a wild ride of ups and downs throughout the market and the journey. And with those wild rides, I personally learned a lot about dividend growth investing and how amazing it can really be. With that being said, I'm going to take us through what these 6 months have looked like for me, my best and worst holdings, and my plan for the future and for this portfolio. Before we get into this video, I just want to say I appreciate y'all for keeping up with my journey and my path to financial independence and early retirement. And something even more exciting than all that is that I can't wait to grow with you guys as a whole, as a community, and just reach our goals together. And with that being said, let's get right into the video. Alright, so let's take a look at my portfolio. So we're sitting at almost $2,500, which isn't too bad. It's not the biggest portfolio in the world, but like I said, we started 6 months ago. We're going to keep on growing this portfolio and growing these dividends over time. And let's take a look at our return rate. So we're about 16%, which is pretty good, not too shabby at all, and $220 gain. And this is something that's going to grow over time. We're just going to keep on investing. I started with $50 every single week, and just recently I bumped that up to $75 every single week. So the exponential growth is going to be there, especially with the dividends, and that's something that I'm really excited for. And that's something I'm going to show you guys later on in the video, how my dividends are going to compound and how they're going to grow over time. Right now, $22 for the last 6 months. Nothing amazing. I mean, it'll pay for maybe a month of Netflix, but you know what? We're just going to keep growing over time and eventually be enough to be able to live off of in the future. So with that out of the way, let's take a look at the portfolio. And I know this is the most exciting part, so let's take a look. So I've definitely made a ton of changes. These are all the pies that I have. So I have tech, consumer, the ETFs, real estate, industrials, healthcare, telecom, financial, and utilities. And you guys can probably tell every single one of these pies represents a sector, and I try to hit it on every single sector, but the one that I'm missing is the energy sector. And I made a video, so I'll leave a link in the description or the top right over here, wherever it is. But I decided to sell it for a certain reason, so you guys can watch that video and kind of figure it out. But long story short, I just decided it wasn't meant for me and it wasn't going to fit in my time horizon. And speaking of time horizons, you can tell that tech has the biggest allocation out of all my other sectors, and that's because a lot of the companies in here are focused on growth and dividend growth. For example, Apple, Microsoft, and Visa. These three right here I consider them my big three, and all of them have a ton of potential, good financial sheets, and they can all basically grow over time, not just in growth, but in dividend growth as well. So I did mention that I made a lot of changes, and that has to do with my tech sector. So Visa is a company that was in my financial sector, but I decided to throw it in here with my tech company just because it kind of represented the same things that Microsoft and Apple did. And that's long-term dividend growth. So right now they're not giving the biggest dividend at all. They're giving a pretty small dividend, and their yield is low. But these three companies are going to grow over time, and eventually I'm going to be able to get a higher yield on cost throughout the years. And these companies, maybe in the next 20 to 30 years when I'm looking to retire, will give it a huge dividend, and then it'll be enough to be able to live off of. So these three companies are my big three. And, I decided to kind of pair it up with higher yielding tech companies like Cisco and Texas Instruments. But you can see they're only about 7% of this overall pie. So they're not like a big component. They're more of like kind of like the fries to the big meal. So these are like the big meal right here where I get all the major dividends and the growth, and these are just kind of here to supplement it. So that's pretty much it for my tech sector. This sector is probably going to have the most growth out of all my other sectors. So let's take a look at some of the other ones. So we got consumer at the second place, and they're about 17%. So let's take a quick look at these. And the same thing, a lot of these are going to be a good mix of companies that are going to grow over time, like Home Depot and Nike, and even Pepsi. And Target's another one. And then it's also combined with some supplement companies that are giving good dividends currently, like Kimberly Clark and Coca-Cola. Gap over here is more of a speculation play. I'm probably going to end up getting rid of it. I just kind of wanted to see how it did. And originally my portfolio started off with like more than 50 holdings, but I've been kind of just trimming it down. And this is one that's probably going to hit the bar and probably won't be here in the long term. But with that being said, these are all my core holdings. A lot of these are recession proof, like Coca-Cola and Pepsi. I expect these to be here for a long term, and I definitely don't see them going away anytime soon. And yeah, my portfolio, this one right here, this pie has been returning about 10%, which isn't amazing, but I definitely expect a lot of growth out of these companies in the long term. and especially dividend growth. But with that being said, let's kind of hop into the third one right here, and this is ETFs. So if you guys have been following my channel, you guys know I made a ton of changes to this pie right here. I used to have VTI, but I decided to kind of split that up just because VTI and VOO were kind of similar. VOO tracks the S&P 500, so I've got 25% allocated to that. VUG tracks kind of high growth companies, so I got 25% allocated to that. And then this one right here, DGRW, tracks dividends that, or sorry, companies that have a high dividend growth. So it's also a monthly dividend payer, so that's pretty cool. So that's about another 25%. And then I've got the rest allocated to SPHD, which is another high dividend yield, but it's kind of low volatility, but at the same time, it's a monthly payer. So these two are both monthly payers, so I decided to kind of slip those in here just to kind of grow my dividends faster. And then the last one right here is ESPO. And this one is one that I'm pretty excited about. It's basically an ETF that tracks the video game industry, esports, hardware related to the video game industry, such as companies like AMD, Seagate. And those are just some examples of some of the holdings that are in this ETF right here. We've also got companies that make video games like Tencent. They are the creator of Supercell, which I believe makes Clash of Clans. They also got the creators of 2K in here and Take-Two Interactives. So they got a ton of holdings, and I definitely expect this industry of video games and esports to grow as a whole. So definitely something that I'm pretty excited about, something that I do, for you guys that follow my podcast, and if you guys watch the YouTube videos for that podcast, you guys know that I do a ton of 2K and Call of Duty gameplay. So definitely a sector that I'm pretty passionate about and one that I expect to grow over time. But with that being said, that's pretty much all I have in this ETF pie. And then a lot of these are kind of smaller holdings, got 11%. So it's nothing too crazy. These are more of the core holdings. So I won't go too crazy into these, but if you guys want to see it, I do have a video where I reveal every single one of these. So I'll leave a link somewhere at the top here in the description so you guys can check that out. I just don't want this video to get too long, but let's take a look at my holdings to see which ones were the best and which ones were the worst. So by the way, the platform I'm using right now is M1 Finance. It's a pretty good way for dividend growth investors to start investing and manage their portfolio better. So I'll leave a link in the description if you guys want to get started with that. I'll make a video in the future talking about it, but it's definitely a great platform that I like. With that out of the way, let's kind of just take a look. So these are the stocks that I have, the shares, the price, and so on. And then this is unrealized gains. So I don't plan to sell any one of these stocks for now. Maybe, like I said before, Gap is one that I might trim because you can see that I have 43 stocks, which is quite a lot. I do plan to trim a little bit, but a lot of these companies are ones that I believe in the long term, and that's why I decided to have them in my portfolio. But let's take a look to see which stocks have performed the best. So Gap, 50%. So that's one of the reasons why I have them. They were first introduced around $10 in my portfolio, and then because Kanye signed with them, the price just started to gradually increase, and of course the whole pandemic started helping it increase too, just because of that giant dip in March. So that's one that I might just take profits and then just reinvest it into a different company. Disney's been great, Qualcomm, Apple. So like I said before, that tech sector is one that I believe to grow a lot. So Apple and Microsoft, you can see VGT is another one that was in my tech sector. So these are companies that are probably going to grow a lot faster, but their dividends are kind of small for now. And let's kind of just take a look at the ones that have performed pretty bad. So we've got Lockheed Martin, Kimberly-Clark, Verizon, AT&T, Visa, which is pretty awesome because I'm getting it at a discount deal because I just keep investing more and more into this company. And then eventually I'll be able to lower my average, which is awesome. So these are just some of the companies that I'm down. These ones aren't too significant because I'm not down by too much. But I'm definitely averaging down where I can. Lockheed Martin is one that I believe is going to do super well. Maybe not in the short term with the new president, but in the future it'll definitely do well. So I'm definitely averaging down in this company right here. Kimberly-Clark has been on a kind of a dip and a downtrend. So it's been a company that I believe in. They have a ton of products. They have a pretty good future and a huge dividend. So I'm definitely investing more in them when I can. Verizon, AT&T are some of the slow comers. I didn't really get to mention this before, but they pay a really high dividend to AT&T and Verizon. So I'm not expecting growth out of these companies, but by the time I retire, I want to have a decent amount of money in them just because they pay a high dividend yield. So I'll kind of just filter this in another way so you can see what companies have the highest holdings. So I have VUG and VGT. These are both ETFs. So I'm playing kind of conservative, to be honest. I like to have a lot more money into an individual stock just because they pay a higher dividend. But one thing I like about investing into ETFs is that it's kind of flexible. So let's just say that one company does really bad. That way I don't really lose that much money. It's all in this ETF. But let's say a company does good. It's the same thing. It's all in this ETF. So that's just kind of my strategy going forward. Eventually, I might end up selling it maybe 20, 30 years down the line and just investing into a high dividend yield so I can kind of, retire early. So let's just give an example. So let's say that BUG, I'm up like a ton of money, so maybe I can sell some of those shares and just buy more AT&T because a lot of you guys know that AT&T has like a 6 to 7% dividend yield, so that would be able to get me more dividends in the long term. So that's kind of my strategy going forward, but these are the companies right now that I have the highest value in, and these two are both growth companies, so that's why those companies are the highest. And then we've got one that tracks the S&P 500. But yeah, these are all the companies that I have with the highest amount of value. And I'm just going to kind of scroll down so you guys can see which companies are up and down and also kind of the value that they hold. And you guys can kind of see that all of my tech companies are the ones with the highest amount of money just because I expect the most growth. And all the companies that are paying out pretty high dividends, for example, CVS, Aflac, let's kind of just go down the list. Verizon are the ones that don't really have too much money right now, but I'm kind of gonna shift my money more to them as I get closer to retiring. So, and these are just companies that I haven't really had too much time to be able to put money in them just because they haven't really been on that much of a dip, or in my opinion, they've been kind of high. But once they have a dip or a small anything like that, I'm going to be putting money into them just to kind of grow their dividend. But yeah, that's pretty much it for all of my positions. But let's kind of just hop into one thing that I think is really cool, and we'll get right into that. So this is a dividend tracker supplied by Tru Financials. So I reached out to Denis from Tru Financials, and he gave me permission to use it. And I'll leave a link in the description to his channel and also for this tracker, that you guys can get it for free. So yeah, he was kind enough to let me use it, and I kind of adjusted it to my own needs. But you can see that I have about 7 months in here. I started at the end of July, or maybe this is 6 months. I can't do my math right, but you can see that I started off with 11 cents, and that was my first month. And now we're at about $2.58, and my highest month was $6.36. So you can kind of see the dividends are kind of starting to grow as I add more and more money. January is typically a month where my dividends aren't going to come in as high as some of the other months. But yeah, I guarantee you by the time we hit December in the year 2021, this $6.36 is going to look like peanuts compared to what this number is going to be. And that's not only because I'm adding $75 every single week, but it's because of the compound growth in the dividends, and it's just going to keep stacking up every single month. So let's take a look at the monthly averages. So for 2020, I had a monthly average of 271. So far, January is $2.58, and that's just because January is a month where a lot of my companies don't typically pay out dividends, but we'll see this in February and March, especially March, where my companies start to pay more and more. So we're definitely going to see this average get higher every single week as I invest and reinvest my dividends. So this is another dividend tracker, and I actually made a video on this, so you guys can check that out. I'll leave it on the top right over here, or over here, wherever it is, I don't know. But with that being said, you can see that my annual income in dividends is $58. And if you guys watched the video I made on my financial and investing goals for 2021, this number at the time was only $50. So in the matter of 1 month, I was able to add $8 every single year. So that's the whole premise about dividend growth investing, is you're going to grow your dividends over time. And we're going to kind of take a look at something that you're going to be able to see that a little bit more clearer. So this dividend tracker has a cool tool called future value, where you can kind of see the future value of your portfolio over time. So one of the things that it has on here is your 5-year dividend growth rate, and that rate for me is about 13%, which is pretty big. That just means that every time a company or a stock that I own grows their dividend, it's going to be by 13% on average for all the companies that I own every single year. So that's just something that's really cool. And then you can see my dividend yield is about 2.33%. And that's actually some problem that I had in the beginning of my dividend growth investing journey, was that my dividend yield was really high, and I was kind of just focusing on the yield more than the growth. This is important because I'm looking to retire in 20 to 30 years, not just currently or not like really soon. So I need to be more focused on this growth rate than my dividend yield. And a prime example of that is a company like Apple. Their percentage for yield is lower than 1%, but their growth rate is closer to this 13%, which is what I'm looking for. So you can kind of see that with this portfolio, or with this graph right here. You can see in 2021, this is my projected value, and then it just goes up every single year. And this is with me adding no money, but just reinvesting my dividends. So you can see if it follows that trend line in 2045, my portfolio will be worth around $11,000. And like I said, this is with me not investing a single dollar. This is just by me reinvesting every single dollar that I have, that I get from dividends. With that being said, you can kind of see that right now my starting annual payment of dividends is $57, but in 2045 it's going to be $1,466. So it's all about growth and reinvesting those dividends. But like I said, I invest $75 every single week. So that number is going to be exponentially higher just because that whole compound effect. So this is just something that's really cool and something I learned about my dividend growth portfolio. All right, I think I talked about my portfolio enough. It's only been 6 months and this is a long-term journey. So we're definitely going to make a ton more videos and we're going to show a lot more of my portfolio and the changes. I definitely have a lot in store, and a lot of my recent videos have all been on dividend growth investing. So this is definitely a great time to be a dividend growth investor just because everything that's happening in the market with GameStop and AMC and everything like that. So it's pretty cool that you don't really have to worry about anything. You just kind of put in your money every single week and watch your portfolio and dividends grow over time. But I like to diversify. So in my next week's video, I'll probably do a little bit more on my $100,000 challenge and where I stand. It's been a wild ride this past week, so I definitely have to show you guys that. Yeah, so I'm definitely going to start making a ton of videos on my $100,000 challenge and a bunch of other things. I definitely have a lot of fun making that, and I wish I could post more, but we're kind of starting to grow that community, so I'm definitely being encouraged to push out more content. And guys, I just want to say that I appreciate you guys for watching, listening, and liking my videos. If you guys got any value or entertainment out of my video or this portfolio in general, I'd greatly appreciate if you guys could just leave a like, comment, or subscribe. If you guys have any questions, you guys know me. Hit me up on Instagram at the Aray Show, or you guys can email me, leave a comment. I'll definitely be happy to help you guys. But with that being said, appreciate you guys, and remember, guys, everybody eats.